Well, we moved past the RBA, the Bank of Japan, and the Fed meeting, and we've had some moves by which we've had to navigate our portfolios through, and as traders, cut our craft in that situation. We analyse and break down the Fed meeting and ask what's the trade going forward. And we've seen new all-time highs coming through in the gold market. We've seen life coming back into the crypto market. European and US equity markets are booming at the moment. It's another day in paradise as we look ahead at a Swiss National Bank meeting, a Bank of England meeting, a Norges Bank meeting, and also a central bank meeting in Mexico. This is the trade-off. Well, hi, I'm Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds by Mr. Blake Morrow, the Fed Whisperer. Mr. Blake Morrow, would you come in? It's been a pretty lively week. We were talking about it last week, about the sort of plethora, there he is, the Hilson wrap, or whatever the guy's called these days. But yeah, look, I mean, last week we were talking about the landmines that were going off this week. We've obviously seen the RBA, Bank of Japan, Fed meeting, which we'll break down in 2 seconds. But it's been pretty lively, and we've seen some nice moves coming through and sort of momentum moves back in the market. Are you feeling a bit better after your holidays? You coming back in now? How are you feeling? How are you reading the markets?
I'd like to go back on holiday, please.
Yes,
Thank you very much.
We want you to stay, but I want to go
about
home.
you, Chris, but the last 48 hours has worn me out, and we're not even done yet. It's the craziest thing. But we knew it was going to be a jam-packed week. We knew there was going to be, as you like to say, landmines. They're all over the place. And
do you think I should stop saying that?
Yeah, but no, I'm saying that you're succinct, and they're going off everywhere, and it's definitely keeping us on our toes. So. So yeah, I mean, what a week, and we still got more left, Chris.
We do have, mate, we do have, and I want to explore them with you. So let's go straight into Topical Thunder. Yeah, look, it was the central marquee event of the week, the Fed meeting, and we have had a few hours now to dissect what's exactly gone down. I think, yeah, obviously the market speaks out. We've seen some relief coming through. Obviously, the binary situation the market was looking for, whether we saw, the central, the median dot plot being taken from 3 rate cuts for this year to 2. It has stayed at 3, only just. We have seen a sort of more concentration in narrowing, a compression in the dispersions, but we've still ultimately got 3 rate cuts this year. But at the same time, Blake, we've seen they upgraded their GDP forecast to 2.1% from 1.4%. I think the sort of top end of the range was about 1.8%. So this was a big number in terms of the growth numbers, and they've increased their core PCE numbers for this year to 2.6%. But generally, the market said, well, that still leaves us with sort of 2% real policy rates. I think you can slice and dice this whatever you want. I mean, the hawks will come out and say that we've taken a cut out of 2025 pricing of dots in 2026, and the long run or the neutral rate has gone up to 2.6%. That in itself could be somewhat hawkish, maybe bearish for markets, but it hasn't been the case. The rates market's speaking out, Blake. I mean, we've seen 2-year yields down 8 basis points. We've added an extra 10 basis points of cuts for December, and obviously risk assets have gone for a ride. So there's relief, and I guess you've got to look at what Powell said as well. I think they're happy to tolerate the inflation prints we've seen recently, and the strong labour markets are not going to be an impediment to cutting rates. I think the market loves that. So I've seen relief. How are you reading it?
Well, you just said it there about the labor markets. I think that's been everybody's worry. Hey, the labor markets are so strong. Is that going to be a concern? When he said, no, not necessarily. I mean, that's like, wow. Okay, well, great, fantastic. That's one less thing that we have to worry about. And also, the Fed is looking past this inflation data. Now, what's also interesting, there's a couple things that are interesting that stand out to me. First and foremost is if he's going to be looking past this data and he says that basically, and you start thinking about the next meeting. The next meeting, there still isn't much. The rate expectations are still very low. So next month is a non-event. He says he needs more data. Then we start getting into a timing issue with political timing issue, with the election. So when you start thinking, how many rate cuts are we priced in? How many meetings do we have? We have 6 meetings left. -1 would get rid of next month. We got 5. where does that leave the Fed room? And here's the thing that I don't want to play politics at this moment. I mean, I don't want to make this a political show.
Go on.
But why can't the Fed lower rates into an election? Now
they've never done it. They've never done it. They've never done it. They've never gone in the history, cut rates or change policy the month before an election. That's
right.
I guess.
But this is the most polarizing election that we have ever seen, probably in U.S. history. So, with that being said, how about if they just continue to plow forward and lower rates into the election? Everybody's going to say it's political, and then it's going to be a big uproar, and probably civil war. Who knows? I mean, but. I mean, I don't know. Timing wise, Chris, how does that work in your mind?
We've got to move on. But I think we are getting into a narrow window if we get into that point. And I think ultimately the Fed, I mean, they've told it they want to cut. I think they want to be in a position to cut rates. The data needs to get to that point, but they've shown us they want to cut. It feels like they want to cut. I do think that I know we've got core PCE coming out on the 29th, and that may be interesting. But I do think that the March CPI print that comes out on the 11th or the 10th of April, I think that is going to be massive, absolutely massive for markets. And if that comes in hot again, then that right tail risk increases, and June becomes sort of 50-50 proposition from around 80%. So yeah, I do think that there is a big debate in the market is what time does it become, do the Fed become too political? As I say, they've never cut rates or changed policy in the meeting before an election, and maybe that's the case. So you will be getting into a narrow point. So that politics is definitely there. But I think for me that they've shown that they want to cut rates.
I agree, and I think the market obviously sees that. And you take the market price action. I know we need to move to the Bank of Japan, but I just want to say this. The reaction function that we saw today with equities higher, dollar down, gold breaking out, trying to break out, and now breaking out as we speak. A lot of that has to do with positioning, and I think that speaks to the Bank of Japan. Which let's go to the next topic, and let's talk a little bit about the Bank of Japan. So this was a historic move from the Bank of Japan. The first time they've raised rates since 2007.
Correct,
right, Chris?
It was, right? Yeah, I was 27. I remember those days.
This is a bit pretty historic for the Bank of Japan. Now, the reaction though in the yen was and Nikkei and everything else was not what the market was expecting. The dollar yen rallied, and then it continued to rally above 150 following the press conference, and a lot of people wonder why the price action was as such. And I think we could probably come to the conclusion that we all took a step back and said, well, the Bank of Japan really they're going to be very, very slow and very measured and telegraph their moves, and they're still the interest rate differentials between where the US is or anybody else and Japan is still so wide. It's not going to close. The gap's not going to close anytime soon. The yen, everybody was in a position for historic move. Yen would strengthen, Nikkei would fall. Didn't happen. So now we have it going the other direction. However, right as the FOMC made their rate decision today, an article came out from the Nikkei, and that kind of came in a little bit talking about how they might have to raise rates a little faster
July,
if they're going to do it faster than expected.
July or October, yeah.
Yeah, and so that threw like a monkey wrench into everybody's master plan that the dollar yen's going to rally above 152 and go to 154, 155, 160, whatever the case may be. So anyway, let me hear your take on the BOJ at this point, and what are you going to do with the yen and the Nikkei? I know I don't want to give it all away, but what are you thinking here?
Well, look, there's a few points. First of all, congratulations to the Bank of Japan. They have absolutely nailed communication with the markets. 4 months ago, the world was going to collapse if the ability to get out of unconventional policy was going to cause huge ramifications around financial markets. we actually saw a sell-off and an easing of financial conditions after they raised rates. It was so well telegraphed to the market, leaked left, right, and centre. They've formally removed yield curve control, but I think the important point here is that they're still going to be buying 6 trillion yen per month, effectively, of JGBs to calm any kind of volatility in the JGB market. And I think that's really key. So I think it's market's obviously well telegraphed. Sell the fact playing through in the yen, plus the JGB but purchase is still very much there when they want to do it. They can get rid of J-REITs purchases and various factors, but it's still balance sheet expansion. And like you say, I mean, OADA at the time was non-committal to raising rates further down the line. And we've talked about this at length, that this idea about a difference between a token hike to get to zero interest rates and the start of a rate hiking cycle, which we've all seen in G10, of course. If we saw that, then the yen's screaming buy and it's going to realise this very cheap levels that we've been seeing. But that's not the case. What's changed and what could be changing is that OADA has planted firmly into the market that any weakness from here in the yen will affect their policy decisions. And that's what came out in the Nikkei. If the yen continues to weaken up through 151.90, those recent highs, pushes into sort of 155, not only is the MOF likely to come into the market to intervene, depending on the pace, but it will affect their chance of raising interest rates. And that's a bit of a new development, which will slow the appreciation, I think, in the yen there. Or depreciation of the yen.
But it was historic, right, Chris? It was historic.
Wow. It's historic as far back as 2007. Like, for me, like, it's historic. It's like it's either never happened or it's like Henry VIII kind of era. I don't know. But we'll call it as historic. That's what's written in the headlines.
Let's do it.
Mate, I'm going to go to gold because we haven't seen. We're talking about historics. We are seeing record levels. I saw it as a closing high, but now it's actually we've just seen it smash through 2,200. And like we saw in the spikes before, it's come at that what we call the twilight hour. This is the rollover from your world to my world, and liquidity is a bit thinner. We're getting a few people coming to their desks. The big hitters, are there, but the liquidity is poorer. So when you get a break of 2,200, you just get this, or the recent highs, 21.95 or so. The market just has this kind of stop loss run. Where are you going to put your stop losses above the market highs? You've just seen a stop loss run in a thin market. The question now is whether or not it can hold above 2,200. But look, for me, gold has been resilient in the face of some modest US dollar strength, a little bit of backup in real rates into 2% in tens, a bit of a repricing out of interest rate cut expectations, and gold's held in pretty well. So I think the buyers were there, and I think a lot of it is down to Chinese buyers. If you look at the level of Chinese activity at the moment, it's really ramped up quite sharply. It's way more than what we're seeing from the Indian buyers community at the moment, and now we've just seen it coming up. So it's kind of like a coiled spring. The question now is, with the Fed essentially saying that, we'll tolerate higher inflation for now, and we'll look through the labour market. Can this continue to go? But I think gold's very much in play. I want to see how it closes through and trades through today's session. But I think what we've seen is a stop loss run in thin liquidity. So how are you trading this gold price right now? I think buying pullbacks is the play for me.
It is, and the thing that scares me the most, as you just pointed out, and one of the things that was happening just as we were turning on the cameras and our producer was getting us set up here, is that it did run through thin liquidity above 2,200, and that always scares me. So whenever things happen during the twilight trading hours, I get a little hesitant. But at the same time, what are you going to do? Are you going to get short? I don't think that's the right play. And gold has set up perfectly over the last week, just a bullish pennant. Even as you pointed out, the dollar modestly was strengthening. Gold just sat at 21.50. It just sat there developing that pennant. It was just primed to rally today. So its target, if the bull flag continues higher, bullish pennant, and it should reach the 2261 level, which is that's via spot, and that would be at the 161% extension. It's currently trading above the 127% extension. So I'm playing it to the long side. It only looks bullish while it trades above this week's lows, which would be 2140 something. There is zero reason to be on the short side of gold, and it looks like
I think the other
legs. Go ahead.
Yeah, I mean, the other thing is there's 2 points. Known ETF holdings have been drawn down significantly. They've all probably gone into Bitcoin and the various cash ETFs that have come through. But known ETF holdings in gold have come right down, the GLD and the GDX. That those inflows need to come back in at some stage. If we see this going higher, we get FOMO, we get people chasing. You're going to see those inflows, and that will be supportive of the gold price going forward. But yeah, I think we've got to take a dollar. I mean, I think there'd been an element of the market who were betting. You talked about positioning earlier in the show. There'd been an element of the market saying, you know what, there's a really good chance that we're going to see the median dot being taken to 2 cuts this year. And we just needed 2 participants to effectively move that. It stayed, but I think there would have been people saying, well, you know, there is a binary outcome. If we get 2 rate cuts being priced in, I know this is very simplistic, but we should see 2 and 5 year rates yield spike up, and that should take the dollar higher. So I think some of that long dollar positioning's come out. Had to react very, very quickly, and of course that's pushed up the gold price. So again, it's not just a real rate story, interest rate expectation story, but it's a dollar story. And I think, you know, if you can get your dollar call right, I think you probably get your gold call right in the short time as well.
You got it. And all right, let's go to the last topic, because you know we're not out of the weeds yet. As far as like I said, I'd like to go back on holiday, but we got the Bank of England. We have the Swiss National Bank, and we also actually have the Norges Central Bank, and we have Banxico, which there could be some more surprises there. And we could talk about those two if you wanted to lump them into this section. But, you know, with the Bank of England coming tomorrow, not a lot of expectations, but you can see, and especially if you look at the euro sterling, we are stuck between 85 pence and 85.80, like this really tight trading range. It's just begging to break out. Now, I'm not expecting anything from the Bank of England tomorrow, more like status quo, but I'd like to hear your opinion there. But I think the big mover could be the Swiss National Bank, and that's going to happen like literally probably about, I don't know, 7, 8 hours from the time of filming. It's going to be in the middle of the night. A lot of you are going to be watching this. There is a risk that the Swiss National Bank does cut rates, because it's all about timing. You know, it's how many bank meetings they have versus other central banks. Your colleague Michael Brown had mentioned that. My colleagues from Forex Analytics have been talking about it for like literally the last week or so. So that is a risk, and you can see the Swiss franc, despite everything that's going on and all the risks that are circling around the market, Swiss currency is super bearish. And you and I have been bearish Swiss francs literally for like the entire year of 2024. So where do you stand on these central banks as we move into the latter half of the week?
Well, we've got 9 basis points of cuts being priced for the SNB meeting, Swiss National Bank meeting. I think, certainly from the economist community, I think there's like 4 out of 20 odd who are calling for the cut. So the economists are certainly sitting on the belief that we're going to see rates on hold. And I think the sort of central view here is that, look, they do want to go and cut rates before the ECB, but the ECB is showing no real signs that they want to do it any time before June. So that's sort of after a slightly stronger Swiss inflation print recently, it does give them a little bit more sort of juice to sort of hold off to the next meeting, which they do on a quarterly basis. So that's why the market's saying that they'll probably hold off. They'll want to do it before the ECB. But look, I think 9 basis points. If they do cut the 25 basis points, then the Swiss franc should go downtown. And I think the fundamentals at the moment really suggest you can understand why a lot of people from a fundamental perspective are pretty bearish on that. The Bank of England, no, I don't think it was going to see much. I think the pound probably trades from here on a risk proxy. Equity's higher, sterling probably trades higher against the yen, that sort of stuff. I think Banxico is really important. Dollar MEX, put it on the radar, because I think the market is probably about 80% priced for a 25 basis point cut. It's been long in the tooth. We've been talking about the potential for a rate cutting cycle in Mexico for a long time. We're pretty convinced it's going to start tonight. Will the Mexican peso respond, given it's partly in the price? But I think we are starting to see some signs of dollar MEX moving a little bit higher. I think a lot of that really depends on volatility now. So if you see higher vols in the market, then you're going to see carry unwound, and the MEX has been your poster child of carry, along with the Colombian peso. So I think higher vols is really bad for that. But I think from anyone who's been trading LatAm currencies and high the high yielders. We should, in theory, see the Mexican central bank start its easing cycle tonight. So another historic moment for us. I do think the Norges Bank, gets the lesser of the sort of focal points from traders But I think it's probably dovish at the margin. But I think, there's Noki care. I mean, it's probably just the high beta risk play more than anything else, isn't it?
Hasn't cared a lot about lot, hasn't cared about crude, hasn't cared about risk, hasn't cared about a lot. So we'll see.
It's probably like the Bitcoin of the FX world, right? Equity's higher, Bitcoin's up 3%, S&P's up 1%, Bitcoin's up 3%, and the Noki's up 1.2%. It's like doesn't really care about fundamentals. It's just a high beta sort of risk play. That's what I said. Anyway, let's go to charts that matter. That's a setup. Right, well, Crude was my play of the week last week, and what I did suggest, whilst it's up, it's pushed into the channel highs, is that we were looking at those channel highs as potential areas for scalpers, and it's, as you can see here, it's worked pretty well. We've had a really nice move up there. Do we get downside, upside? It's a question I'm going to ask for you, Blake, on the back of this one. But I mean, obviously the fundamentals have warmed up a little bit recently. I know there's been some sort of geopolitical issues in Russia, which is sort of pushed back on the supply side. People talking about inventories and various factors that have compelled the fundamentals to be in a more positive spot. But it's an out and out supply story, as is the case in copper. As is the case in a lot of the, so cocoa. I know you can see that on the next one. But the commodities complex more broadly are breaking out. And I think crude has gone along for the ride. You look at RBOB, gasoline. I mean, that's been an absolute tear, which has lifted short-term inflation expectations to an extent. But I think in terms of the distillates and the refined products, there is getting pretty tight out there. And it may say that we may have to see changes from OPEC later this year, certainly from around Q3, because how tight it's getting. And if price continues to move up, I mean, obviously that's going to be a big political statement that comes through, given the drawdown of the of SPR. But I think the fundamentals have been positive. We've reached the top of the channels. The scalpers have had something to work with there. How are you seeing this one, Blake?
Well, I'm seeing it just like you, and that's attributed to your analysis from last week, Chris, because I've been talking about you on our shows, on our Forex Analytics shows throughout the course of the week, that, hey, you had your eye on the ball here, and Crude respected that channel resistance perfectly. So well done. Now, I do think it's still in breakout territory, and I think while it trades above 80, 50, $80 or so, you got to be respectful of the fact that it's still in breakout territory. So, and as you pointed out, the rest of the commodity complex has really been breaking out to the upside. So I still like it. I think there's some catching up it can do, and especially based on what's happening in risk and what happened with risk following the FOMC. I think we could probably be trading up, as long as 80 holds. We're going to be trading up towards 84.50 to 85 here within the next week, I would think. So I still like it. I still like it as well. I think I think weakness will be bought. Right. No, I agree with you. All right. Well, the next setup, the first setup that I'm going to bring is cocoa. And I had to ask you guys because I wasn't sure if you had the cereal, Cocoa Puffs. And everybody, the whole market's gone cuckoo for Cocoa Puffs, and you can see really, really strong rally. I was reminded by another analyst just recently talking about blow off tops and capitulation bottoms, that a lot of these usually transpire. They happen more in the commodities complex than they do in like financial instruments like the S&P or whatnot, but which we've talked about blow off tops before, and which we will talk about again. But the fact of the matter is, this cocoa has rallied quite substantially. It's stalling, and relative strength is divergent. So the setup would be, and this is your CFD that you're using. You can see that previous resistance on that daily chart comes in around 77.50. If we drop back below 77.50, I think it sets up for a nice little pullback below 7,000. It's a setup. Remember, if you're trying to fade this type of capitulation type of move, blow off top, be very careful. Keep size, keep your stops tight, keep your size appropriate. But that's a setup that I think, it's a little juicy for a potential reversal. How are you seeing cocoa right now? Are you cuckoo?
I was going to say, this is like the pun central, isn't it? You can just come out with anything to do with cocoa. But I mean, it's not often you see cocoa come up on clients' radars and see trading volumes pick up. But when you see a chart like that, you can understand why. I mean, everyone's trying to short this one at the moment. But yeah, obviously the fundamentals, again, it comes down to supply, and supply in parts of Africa have come right back. I'm not going to go into too much because it's not. I'm not an expert in that world, but there's a lot of stuff as to why this is going on. When you see a move like that, there's obviously a clear reason behind it. But then you get all the CTAs, the trend followers, the systematic guys pushing us up, and you go back to the point. Trend followers dig the softs, the agricultural commodities, along with bonds, probably more than anything else, because they have these moves, these trend moves, these momentum moves that come out, where the sellers dry up, and the sellers are just selling at higher prices all the way up, and people are buying at higher prices as well, and that's what you get, this massive move. So yeah, this is a world that I love, because while the spreads are slightly wider, and obviously wider than euro dollar and some of the indices, you get moves like this, and the propensity for these outlier moves are very much higher. That's why I love them. But I agree with your analysis here. It's too hot. That divergence has got you on edge. A break of those lows, and that's where I would be looking to increase my conviction of shorts. But I wouldn't be doing it right now. Not when the chart looks like that, and we're pushing new all-time highs or new highs in this run. Wait for that setup to come in play, and that's where you increase your conviction. But I wouldn't be blindly shorting right now. I'd wait for that probability to increase a little bit there. So great chart, and it's been well talked about there. So very, very good indeed. Let's go to talk something else that's been very well talked about. We've been talking about dollar yen in this situation. But let's have a look at this from a technical perspective, Blake, because I know that you've got some strong thoughts around dollar yen, but we had that sort of consolidation move that we saw back in February. We've reclaimed that level after making a move into sort of the mid 146 levels. Obviously, the market was running long dollar positions and closing out those short dollar positions into the Fed meeting. We got to push back into those November highs, and then obviously, as you talked about, that Nikkei articles caused a little bit of a move lower back into that form of distribution. But it is kind of make or break time. I mean, the dollar's weakened off against various currencies, like pro-cyclical currencies, but against the yen, it's still a strong story. So how are you reading this one at the moment?
Well, I first of all, that dip into the mid 140s, that was only a 38% retracement. That's the one thing that I have to be respectful of, that we're still in an uptrend. We didn't create a lower low on that dip. It was like equal, slightly higher low. So, I mean, the dollar yen still looks like it could squeeze. You're right. That Nikkei article did put the kibosh. Plus, we had the dollar come under pressure pretty much across the board, so it's not helping at all. But that 152 level is really a big risk, and I think one of the things that hasn't been talked about a lot, but we need to resurface the talk of potential intervention, yen intervention, should we get above 152? Because if you look at all the other yen pairs, like the sterling yen, euro yen, Aussie yen, not so much the Kiwi yen, Canadian yen, those are all breaking out to the upside. So when you're seeing the whole yen complex moving higher, yen lower universally, it really does increase the risk of yen intervention. So I'm a little nervous, but I've got it coming up. So I'm going to talk a little bit more about this dollar yen. So make sure you stick around.
I think you get a break of 152. Candor and the big dogs on the Ministry of Finance. The headlines coming out. It's going to be headline city. It's not just going to be about the Bank of Japan leaking these articles in the Nikkei about how it increases the chance of rate hikes in, say, July. But it's more about the Ministry of Finance then, and I think through 152, it's going to be the headline run rate will increase on a daily basis. Doesn't mean they're going to do it, and I think probably the chance of actually proper intervention through the Ministry of Finance comes north of 155. But there will be headlines ahead just alerting us to not sell the yen effectively because you're on edge. So it's an interesting one there. So, but check
rates, Chris. Checking rates.
Yeah, check rates. Well, that's your big one there. So it's an interesting chart. This definitely gets a big run rate. So let us know, viewers at home, how you're seeing the yen pairs, because I know there's a lot of interest in the moment.
I'd love to hear, because we got a lot to talk about still with the dollar yen. So let's move to my last setup, which is the S&P. And basically, I want to just talk about the anatomy of a blow off top and what's been developing and how it's been developing. We've talked a little bit about this over the last few weeks, and I remember I made mention of a potential blow off top in the market. had some comments down below, and you can feel free to comment down below about how people are like, oh, that's exciting, how we could possibly get that. But I want to show you how it develops. Okay, so first of all, you got the green ascending channel, the big long-term one. You breach it, you get above it, and then it sustains a breakout. Then you get another channel. So now you got the blue channel, right? The blue channel, S&P is running a little bit higher, as far as increased acceleration, move higher, not making lower lows. It's just making higher lows. Then you breach that resistance, which we're doing right now today. We're above that blue channel. Then it shifts to another channel, which is even more parabolic, which is now a red channel. So we're now getting to the point where things could really start to accelerate. Should the market get FOMO? Should the market say, throw up its arms and say, you know what? I can't beat them. I got to join them. Or, you only live once, got to get long. Or, I'm not going to be able to beat this market. So I got to jump in now. Once you start getting that attitude, that's when you start getting that accelerated blow off top potential. Chris, that's the anatomy that I see developing in the S&P. How are you seeing it?
Yeah, I like that. It's a school day. That's your Blake school day. So I think it's an interesting one. But yeah, like we've had the rotation coming through, and I love that. Small caps are now outperforming. We were talking about being short last week, and it worked for a while, and it's reversed hard. So obviously we wanted to cut out that one, but small caps are finding their day in the sun. Financials are working really well now. We're starting to see some support in NVIDIA, and obviously that's really important. We're going through the GTC conference. It's not really blowing the lights out in terms of, but expectations are so high. But the good thing is that tech is holding in, right? But now you're seeing rotation into financials, into other areas of the market, and I love that. I think that's really bullish stuff. So, I think it might be a blow up top, but for now, I'm still favouring further upside. As this is the case in Europe as well. I mean, European equity markets, they're all record highs in not just in euro terms, but in other currencies. And I think the Nikkei looks pretty strong as well. The ASX looks pretty strong. So I'm sticking with I'm sticking with this. The market does not want to de-risk equity positions when the Federal Reserve is saying that we want to cut rates. Why would you do it? Because if there's any issues out there, the Federal, from an economic perspective, the Federal Reserve will cut and throw liquidity at the issue. The only thing that really derails that central thesis and causes a 10% down move is if inflation expectations ramp up. The right tail risks are where the equity market does not want to see, and the fact that the Fed are happy to see through them for now keeps us moving the equity market up. But that potentially changes in the next CPI print. Go.
And the last thing, when I'm just talking about the anatomy of a blow off top, the kicker is then nothing matters. The kicker is, for me, you have to see a massive intraday percentage move and completely give it up. And when I talk massive, I'm not like exaggerating, like, oh, it's up 1.5% and then it reverses. No, we got to see a 5, 6, 7% up day, like literally, and then the market give it all back. After that, Chris, nothing matters. You could argue till we turn blue in the face on why the stock market's going to be going up and why it should be going up. That once that price action happens, there's such a high probability of a reversal, and then everything turns sour. But we're not there yet. It's where it's like, as you pointed out, market doesn't want to de-risk. Everybody's chasing, and everybody's got to get on board. I got to see every bear turn bullish. We got Nouriel Roubini, Dr. Doom, finally turned bullish. What, last week? I thought that might have done it, but no. Apparently there's more bears out there. Get rid of them. Okay. As soon as they're gone, then we'll talk. So
cool. No, I think you're right. Play of the day. Let's go to it. Well, there you go. I was kind of spoiler. Long JPN, long Nikkei, effectively. It's going up, right? And fine. If we were to see a big reversal lower, higher in the Japanese yen, I think that's going to have implications for the Japanese market. And I guess the negative, the risk that you have is that what we've seen for so long now is that because the Bank of Japan have been able to buy J-REITs and ETFs effectively when the Nikkei is down and the Topix is down, 1.5% or so, then we see buying of ETFs and that supports the market. That's not going to happen to the same extent now. They can calm volatility in the JGB market, the government bond market, but they can't buy those ETF support stocks. But the market's shown that they don't really care at this point. So this is the high momentum move. We like the return on equity you're getting in that space. We like the earnings profile. Wage growth's improving. Tourism numbers are improving in Japan. It's good enough for Buffett, all those kind of factors. But it's going up. And I think in this market, what we've seen is momentum has worked just better than most things. I know vol-adjusted carries worked to an extent over the last 12 months in FX markets. But momentum has really been everything, and in all asset classes, whether it's gold, Bitcoin, Nasdaq, Nvidia, and when you get a momentum move, you're jumping on for the ride. And right now we're seeing that in the JPN 225. So momentum works until it doesn't, but right now momentum is working, and I want to continue to go along for that. So a lot of good fundamentals, a lot's going with the yen. I like it higher. I don't know how high it could go. Another 3-5%, who knows? 1%, it doesn't matter. It's going up at the moment, and I like it, so I'm long.
You know what? I'm going to join on the Westy barge, the Westy party barge, and I'm going to go take it to the dollar yen. So that's going to be my play
That
today.
party finishes early these days. It's getting old, mate.
I know. It's like, the party barge is over at 7:30. It's PM. It's not AM. Come on, man. Let's do this thing. Let's do this. All right. Hey, dollar yen. We, a few weeks ago talked about bullish flag. I still think that bullish flag is doable. You'll notice the 200 DMA, that was that dip, as Chris pointed out, into the 146s. It's also 38% retracement of the December 29th low to the February 13th high, right around there. Anyway, it was a 38% retracement. That means it's still valid for a continuation pattern. What would be really epic would be tonight, tomorrow, the next day, the dollar yen just blows through 152. It looks juicy. Dealers are looking at it at all those stops above 152. It looks juicy. And if you can just ignore what that Nikkei article that came out, and if the market does that and blows through 152, I think we trade up to 153.50 to 154, and you're going to meet my sell order right around those levels. You're going to meet a few of them, actually. I got a few layered ones up there. So you'll see me up there if we get there, Chris. I'll be fading.
Well, I think I'll probably be there with my JPN 225 trade, because if it goes up to those levels and then the yen starts reversing, that may be the cue. Then that I'll send the price action to take off the long. Obviously, we've got stops in place as well. Define your risk, but I think if we were to see dollar yen move up to those levels, obviously the yen effect on the market will be very positive, and the Nikkei will benefit from that trade as well. So the two plays today are linked, and maybe our reversals are going to be linked as well. So an interesting one. Anyway, it's been a big week. We've been central bank city, and more to come. It's an exciting time in markets. I hope everyone's trading it as well as you can. We'll see you back next week for more of the trade-off.